Most financial professionals are far from experts in mathematics, and you will often find them throwing around terms like volatility and beta, but giving little thought to what those terms mean and the interpretations that can be associated with them. In today's video, we're going to break down beta, and what the term means, how it is calculated, and how you should really be thinking about beta in terms of asset prices. Moreover, we'll be highlighting the shortcomings of beta and how not all betas are calculated equally. As a reminder, there will be some math in today's video, but don't panic. We will be including an Excel sheet in the video description, which should help to model out some of the concepts we've highlighted today. So let's dive in. Beta belongs to the family of modern portfolio theory, which was pioneered by Harry Markowitz. Markowitz was awarded the Nobel Memorial Prize in Economic Sciences in 1990 for his contributions to the theory of portfolio selection. In his paper, aptly titled Portfolio Selection, published in 1952, Markowitz introduced the concept of beta. In this paper, Markowitz defined beta as the systematic risk of an asset in relation to the market. Systematic risk refers to the risk that cannot be diversified away by adding more assets to the portfolio. This risk is inherent in the market itself and is caused by macroeconomic factors such as inflation, interest rates, and political instability. An asset with a high beta is more exposed to systematic risk, while an asset with low beta is less exposed. So what does this mean? Think of beta as a number existing around the number 1. A beta of 1 means that the asset in question has the same systematic risk as the greater market or benchmark you are measuring against. For large US cap companies, this is normally considered to be the S&P 500. When beta is 1, assuming a perfect relationship, when the market is up 3%, then the asset would be expected to go up 3% as well. Likewise, if the market was down 3%, the asset would be expected to go down 3% as well. So what do betas of more or less than 1 mean? A beta of more than 1 means that the asset in question has more systematic risk relative to the benchmark. If the asset had a beta of 2 and the market were to go up 3%, this means the asset would be expected to go up 6%, or 2 times the movement of the market. Likewise, if the market were to fall 3%, then the asset would be expected to decline 6%. The same is true for assets with betas of less than 1. If an asset had a beta of 0.5, then the asset could be said to have less systematic risk than the market, and declines in the benchmark would result in smaller declines in the asset price, while gains in the benchmark would result in smaller gains for the asset. So, how are these numbers calculated? The official formula for beta can look somewhat cumbersome and is found by taking the return vectors of an asset and the benchmark and using these to first find their covariance and then dividing this covariance number by the variance of the benchmark's return vector. This gives us a single value, which is beta. Conceptually, this can be hard to visualize, so let's think of it differently. Here, we will think of the return vectors as points on a graph. When the asset and the benchmark's respective returns at a given period of time are plotted against each other, we can see the resulting. Now we have a graph, which plots our asset and benchmark's values relative to each other. By taking these points and calculating a line of best fit, we can now fit a trend line between the two vectors. This is often referred to as the regression method. The line of best fit will have a formula associated with it. If we consider it in the form of y equals mx plus b, we can simplify beta by throwing out the y-intercept, or b value, which leaves us with mx. X is a variable and represents the amount of change in the benchmark, while m is the slope of the regression line. This slope, m, is equal to beta. In other words, if you were to move 1 unit out on x, or 1% on the benchmark, then you would be moving m% with the asset. Students of finance often find this representation of beta as more intuitive and less conceptual than the covariance methodology. However, both methods are good to know, and when calculating beta in Excel or programming software, the covariance methodology is normally the easier of the two approaches. This brings us to the shortcomings of beta. Beta isn't perfect, far from it. This is because stock prices are far from perfect when compared to the benchmark. Let's consider our regression example. In our example, the points are fairly tight, representing a strong correlation between the asset and its benchmark. However, what if the correlation was weaker? We can still get the same line of best fit, but our points are more spread out. This idea of fitness can be defined in a concept called r squared, which is the correlation of our two return vectors squared. An r squared approaching 1 represents perfect fit, while an r squared approaching 0 represents randomness. Therefore, depending on the r squared of our relationship, beta can be a stronger measure of systematic risk or a weaker measure of systematic risk. Many financial professionals make the mistake of assuming beta is perfectly fitted, and that beta can be applied similarly across all assets. This is not the case. Moreover, there is a problem in calculating beta, which is, well, how do we calculate it? We already know there's a standard formula for calculating beta using the covariance methodology. But what about the return vectors? The return vectors can represent splices of daily, weekly, monthly, or really any time interval of data. Also, how many of these data points do we include? 20, 50, 1,000 data points? There's no standard definition for this, and many financial professionals have their own method for evaluating beta. But worse, some don't even know how to calculate it, and are accepting the number they see on the screen as face value from their data provider without knowing the data provider's methodology. This doesn't mean beta is not useful. It only means that you, as a financial professional, need to know the limitations of this value and when you should and should not consider beta when applying it to a portfolio. We hope you've enjoyed today's video and now better understand the applications of beta in finance and portfolio management. If you like content like this, be sure to leave a like and subscribe to our channel for more videos. Now, please enjoy learning about some of our other topics that are available on screen now.